Welcome to the Explainer. Have you ever wondered what it actually looks like, from the inside out when a massive financial bubble finally bursts? Well, today we're exploring a pretty dramatic, hypothetical scenario to unpack the exact mechanics of a market crash and really look at the powerful psychology that drives the whole thing. We're going to break down the anatomy of an AI bubble, and by going step by step, we can see exactly how a single moment of fear can cascade into a historic financial avalanche.
Okay, let's dive into this. I want you to mentally transport yourself to a very specific time frame. It's June 2026. We're standing just a bit in the near future, and the market has been riding this absolutely unbelievable high, totally fueled by the promise and massive expansion of artificial intelligence. Everyone is heavily invested, confidence is arguably way too high, and the entire ecosystem just feels invincible. Setting the scene is so crucial because it establishes the height of the tension. When you're at the absolute peak of a mountain, the only way left to go is down, and that drop, it's going to be incredibly steep.
So let's look at phase one. The trigger. Every historic market event has an origin point, right? A single spark that lights the powder keg. Before all the widespread chaos, before the massive numbers hit the headlines, there's always one localized event that catches the market completely off guard. And here is our spark. A sudden Broadcom share price drop. Out of absolutely nowhere, the stock of this major semiconductor player just plunges. Nobody saw it coming. And that element of pure surprise is exactly what makes it so dangerous. We're not talking about a slow decline here. It's a sudden, sharp drop. In a market where literally everything is interconnected, a plunge like this in a massive company like Broadcom acts like a localized earthquake. But, as you'll see, the real danger isn't the initial earthquake, it's the tsunami that comes right after.
Which brings us to phase two, panic and contagion.
Let's actually map out the exact psychological domino effect happening inside a retail investor's brain as this unfolds in real time. Step 1, Broadcom drops. Step 2, the mind immediately kicks in and creates a narrative. Our investor assumes, hey, if Broadcom is falling, all the other semiconductor companies are definitely going to drop too. Step 3, driven purely by fear, he takes action, completely selling off all of his shares in giants like Nvidia and AMD. And then comes step 4, the true contagion. He looks around and realizes that everyone else is doing the exact same thing. Individual panic literally transforms into a massive, unstoppable herd selling off major chip companies. It's a self-fulfilling prophecy, and it's playing out in a matter of minutes.
Phase 3, the macro devastation. Let's move to and see how this builds, because what starts with one anxious investor at their computer quickly spirals totally out of control. Zooming out from that individual psychological panic to look at the sheer market-wide destruction, just consider this number, $1.3 trillion. So the absolutely crucial point here is that this isn't just a bad day at the office for a few day traders. This is a mind-boggling scale of wealth vanishing into thin air. Almost $1.3 trillion with a T was completely erased from the market in a single day, all due to this panicked, contagious sell-off. It's almost impossible to wrap your head around that much capital simply evaporating just because of collective fear.
But how did that loss actually distribute across the broader market? Well, the collateral damage was immense. On that exact same day, the Nasdaq fell by 4.13%. Now, the Nasdaq is a massive, tech-heavy index. It represents a huge swath of the modern economy. A drop of over 4% in a single day is incredibly severe. It shows us that the panic didn't just stay neatly confined to a few chip makers. It dragged down the entire technology sector right along with it.
But the real epicenter of the crash? The Philadelphia Semiconductor Index, widely known as the SOX. It plummeted a massive 13%. Just think about that for a second. 13% of the entire semiconductor sector's value wiped out before the closing bell even rang. This was the direct target of the panic, the absolute ground zero of the devastation, driven by all those investors aggressively dumping their Nvidia and AMD shares at the exact same time.
And this brilliantly illustrates the true shape of the crash. The broader tech market dropped by 4.13%, but compare that directly to the severe, highly concentrated devastation of the semiconductor sector at a whopping 13%. So yes, the whole tech world definitely felt the pain, but the chip sector took a historic, concentrated beating. It perfectly visualizes exactly where the fear originated and where it hit the absolute hardest.
Finally, phase 4, the aftermath. The closing bell eventually rings, but guess what? The panic doesn't just stop.
Let's bring the narrative back down from the trillions of dollars and the big index percentages, back to the reality on the ground. After seeing the initial drop, after panicking, and after frantically liquidating all of his Nvidia and AMD positions to escape the crash, our investor's emotional state is incredibly clear. He is still very stressed. He took action to try and save himself from the plunge, but he sure didn't buy any peace of mind. It just goes to prove that panic selling rarely provides actual relief. The stress of that market chaos lingers long after the sell button is clicked.
Which leaves us with a truly vital question to ponder as we wrap up this explainer. Was the investor's panic merely a symptom of the crash, or was his herd mentality the ultimate cause of that $1.3 trillion evaporation? Did the market crash because these companies were actually failing, or did the market crash simply because everyone believed it was crashing? It really highlights the incredibly fragile psychology behind an AI bubble, or really any financial bubble for that matter. I want you to take that thought with you today. Thank you so much for exploring this wild scenario with me, and hey, keep your eyes on the data.